credit. It's like a subprime problem in China, what's happening in the Middle East, what's happening in Greece and Europe. Where do people want to bank their money? And I think if you look at sort of an interest level, I'd say Toronto comes out number one. People figure out a way to come here and invest their money in residential housing. It's a safe place to put your money. So based on kind of that, which is not necessarily on economic fundamentals, I could see prices in the next 2 years in Toronto for, your kind of product going up anywhere from 20 to 30% in the next 2 years. And we see it in the single-family resale. I've never seen, driving around some of the nicer neighborhoods, houses that were sitting around for $5 million and $8 million. Suddenly there's sold signs all over the place. It's also in the 905. If you look what's happening sort of at the top, in the top neighborhoods in North America now, the 10, the 20, the $30 million properties are starting to sell everywhere. We were talking before the session, the group, just sort of getting to know each other. The Ritz-Carlton, top of the top in luxury high-rise, the same property, if it was in Paris or London or New York or Rome, would be double or triple or quadruple a price. So there's still room for this small, this world that's getting smaller and smaller, for that demand to, in my mind, increase for Toronto. It's not going to be Windsor, it's not going to be Ottawa, it's not going to be Montreal. Toronto is a unique market unto its own.
Okay, so we've got two really optimistic discussions of the state of the residential market. Okay. Well, I mean, you started by saying you didn't know, but that as long as volumes were still good, you were pretty comfortable.
Well, that's true, but I'm not going to...
Not 20 or 30%.
He's a broker.
Okay, but residential real estate is only one of the really important real estate markets. Commercial is an equally important market. Dori, what do you think about the state of commercial markets in Canada, in Toronto, Canada, the world?
Well, real estate is a funny business. For the most part, you'll meet a developer who just sold, whether it's a big residential tower or a commercial piece of real estate, and he's extremely happy, sold it for a great price, and he'll tell you we're in a bubble. Then you ask him, what are you doing? He say, I'm going to buy this piece of land. It is a great opportunity in the middle of the bubble. And you see it all along. I really think that when you look at real estate, you have to really analyze every situation separately, because real estate has very few times where you're in a real bust and when you're a real peak. The rest of the time, you are in a zone where it feels like it's expensive, but people still do business and make money. And if they're not over-leveraged and they know what they're doing, you can still make reasonable money in real estate. The best real estate transaction I've ever done, when I got into this business in 1985, my first piece of real estate was a partnership in a syndication in an office building in San Francisco. I invested $60,000 in April. By August, I lost $60,000 and I got left with a tax liability. And the reason why I'm saying it's the best real estate transaction I've ever done is because it really taught me a lot, because the guy who was a syndicator and ordered and organized the group made 150% on his investment on closing. So real estate is not a business you can just say, okay, real estate is good or bad. I think that when you look at commercial real estate and you compare today to 20 years ago, and it's very funny, in 08 and 09, not a single investment grade rated commercial real estate company in North America, not only in Canada, which fared much better than the States, but in the US, was even in discussion with its lenders to postpone one interest payment. And while banks that had mortgages on their balance sheet and were rated AAA and AA went bankrupt, real estate companies that are basically a BBB minus business or BBB low, BBB mid business, not a single one of them got into trouble. Because when you think about the commercial real estate business, we lend space to the same businesses that banks lend money to. But we do it at 2 times leverage, and banks do it at 20 times leverage. And that's one of the fundamental changes in the business in the last 20 years. You're less levered, and the quality of operation, when you look at most of the guys that run sizable real estate commercial income-producing properties or development companies today. 20 years ago, we were all a bunch of schleppers. I don't care who it is from the business. You take Mr. Sunshine, you take everybody who today runs large companies. I can tell you, I was there 20 years ago, we were a bunch of schleppers. We had 20, 30 properties, we didn't know what we're doing. We were over-leveraged. Some of us thought that dollar borrowed is dollar earned. Then they later on learned that that's not the case. And if you think about the companies that really went bankrupt at the 80s, there were companies that had 70 or 80% of their balance sheet in development, and on top of it, there were 80% leverage. And I can tell you, I've been in this business now since 1985. If you run a business, I don't care how talented you are, that is 70, 80% in development, and is 80% leverage, you will go bankrupt. It's only a question of when, not if. But if you run a business that is much less leverage and you have the right combination in commercial between income-producing properties and development and some entrepreneurship, but some core asset that has been there for a long time and are well located and gives you nice and steady income, and you do the underwriting properly for your tenants, you will stay alive, which is the number one and most important thing in real estate, because real estate, I can tell you, at least my experience, it's a great business. It's a little slow in the first 30 years. But after that, it gets a lot better. You just got to survive the first 30 years. And the reason why I know that is because my partner, who's much older than me, taught me a lot of things. I think I got into real estate on time, and I got in with a partner who was the chairman of our company, who's been around, and that was very helpful.
I mean, in discussing the business, what sort of macro factors go into your projections? Because when you pick up the business section of the newspaper, we get doom and gloom every single day at this point. I mean, is that something that you think about, or do you just assume that you can ride out the macro cycles?
I think specifically the shopping center business, which is somewhat different than office or industrial, we really don't read the macroeconomics. The shopping center business is all about picking the right corners. And when you think about the shopping center business, when you get into a recession or a real drop in consumer spending or oversupply of commercial space, which really is 6 or half a dozen, whether you build a lot more than you need or there is a drop in consumer spending, the effects is the same. So if you take a trade area that has, let's say, 10 or 12 shopping centers, 2 of them will die. And the real, I think, challenge in our business when you go into a new trade area is to identify the dogs. If you can identify the bottom 2, 3 shopping centers that are actually not going to work in the next recession, you'll do okay. So it's a very, very locally oriented business. The bottom line is I read the Wall Street Journal for fun. It doesn't do any help when it comes to our business.
I mean, with your optimistic projections, Stephen, I mean, how do you feel about the macroeconomy? Is that based on sort of the view that the European politicians will pull everything out of the fire now, or do you think that doesn't matter for Toronto or even helps us because we'll be the last economy standing?
Well, we may be the last market standing, maybe the reality of it, but long-term interest rates don't look like they're going anywhere but sideways. I mean, Harper came out yesterday at G20 and said, you know, our employment figures aren't great. He lost 50, 60,000 jobs. So I don't think the Bank of Canada is going to, you know, gear up the rates so quickly. And as long as those rates are low, that's really the impact on the residential market. But so much of this foreign purchasing, I mean, when Garnet is saying 90% are investors in, you know, the units that he sold, how many of those investors are, you know, non-immigrants who are, you know, buying a unit here so their kid can go to U of T or whatever the case may be, and have incredibly patient, expectations of return. They don't care. They're popping $500,000 or $1 million into a unit, and whether there's no return, they're going to hang on to it for 5 or 10 or 20 years. I think that is an aberration to the reality for the person who's really living here, who's a resident of this. There's some social factors and impact that this is going to have on the real people who are trying to work at real jobs in this real city who aren't going to be able to afford. And part of it is there's no new rental stock. I mean, you know, who has built new rental accommodations? Garnet's point is true. There's no service land. The cost of low-rise new land is prohibitive. So anything that's going to be built is going straight up, and no one's building rental stock. So you kind of put that all in the hopper, and why would things, quickly deteriorate? I don't think they will. And especially, if you read this, I read the Wall Street Journal also for entertainment, but there's some real good residential sort of perspective on marketplaces in the States and the rest of the world and what's happening. And people are buying these, units in Manhattan. You read stories, $20 million condo so their kid can go to Columbia, and maybe the $28 million condo at the Four Seasons, the penthouse, was bought by a Russian. Is that guy going to immigrate? He just bought it, and whether he parked $28 million there because he thought it was the most safe place to put that $28 million, that says a lot for it.
How do you feel about macro factors, Garnet?
How do I feel about what, sorry?
About the current state of the macro economy and what that means for the future dynamics in real estate?
Well, we spent a lot of time on that. Because we're investment counselors, we do a quarterly economic forecast, and we start with macro, and really in relation to real estate, we're looking at interest rates primarily because it is a financial asset, and we do a scenario approach to forecasting where we get economists who every quarter submit an economic report to us. And I've always tried to choose economists who are somewhat off the wall. There's certainly one thing about economists is that the one thing you know for sure when you read an economic forecast is it's going to be wrong. It's just it's the degree to which it will be wrong. And I like to deal with economists who are able to stick their necks out. You can work as a bank economist, and you'll be a very, very smart guy, but you're never going to stray that far from the norm because you'll lose your job if you do. So I like one of my contributors over the years before he became more important was Alan Greenspan, and he would do a quarterly economic forecast along with another fellow named Arthur Oken, who was on the Economic Council of Advisors in the United States. And we had the Brookings Institute would do some stuff for us, and they'd all give it to us free because they'd get the result, which made us feel good. And we would assign probabilities to the outcomes. And we've always managed our business on the basis we must survive in the worst case. And that's why we pay a lot of attention to these macro forecasts that we have, because if we can survive in the worst case, then we're going to be okay. And Dori was right on the money. I agreed with everything that he said. Leverage, we buy our land with equity. We don't leverage land at all. And we wait for the right time to develop it. And so that's very important. We have a lot of very, very negative things going on too. I don't mean to be totally an optimist, but I know if you buy a condominium today on the resale market, and it's bought as an investment, you're going to make 2 to 2.5% return on your investment. And that's perhaps all right if you can get a short-term mortgage at 2.05%, which is what you could do today if you walked into the bank. You get 2.05%. But if rates go to 3%, that's a 50% increase, and that's not a heck of a rise in interest rates, and that's going to bring that market to a halt. But at the same time, we don't have any rental stock in Toronto, and there's no place to live. And those units are being bought and rented, and it's not that hard to rent it. There are actually, in some cases, some bidding wars going on where people are paying 6 months up front or paying more than the asking just to be able to have a place to live. So there's this huge demand in the market right now that does have to be filled. We have up to 100,000 immigrants a year coming into this city, and they all need a place to live. And while many of them can't afford to buy the units that we're selling, the investors have those units. And I suppose out of all of it, I did some thinking about what I might say here before I got here. My conclusion out of all of it is that rental rates in this city are going to rise. They will have to rise. And everything is pushing in that direction to move us up. But I started to talk about the macro, and I just wanted to say that we spend a lot of time on the macro. It's very, very important to know where interest rates are going.